Have you heard a negative thing or two, or maybe even 10 negative things about whole life insurance? And then you turn around and you hear somebody talking about how great whole life insurance is? That can certainly be confusing because it's tough to decipher who's right. But today we're going to highlight some of the differences and we're going to settle that debate once and for all.
Enjoy the episode.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today we're going to be talking to you guys about why this is not your mama's whole life insurance. Anthony, I'm excited about this episode. How about you?
Super excited. Just the excitement level you have, a couple notches higher, right? And the reason being, you know how passionate we are about infinite banking and whole life. And we often hear people say how terrible whole life is. Mm-hmm. But I always get to is, if whole life is so bad, why is it still around? I mean, this product has literally been around over 200 years. If it's as terrible as what people think, people would have realized that by now, that it is a terrible product and they stop buying it. But if anything, people continue to buy more and more. Mm-hmm. So there's got to be something to it. So the purpose we wanted to create in this episode is let's look at the truth and kind of, you know, when people talk about, when they badmouth whole life, we're going to be up front. Oftentimes they are right about kind of what we're talking about, your mama's whole life policy. But with infinite banking, the policy design is very different. So when you're hearing those bad things, those aren't related to infinite banking. It's more related to your mama's whole life. So what we're going to do here, we're going to kind of compare a few different options with whole life. I mean, or your mama and infinite banking. And we're going to talk about death benefit, cash value, flexibility, and we're even talking about commissions for us. Mm-hmm. So I'm super excited for this episode.
Well, now I'm even more excited. And I'm even like, you're here and I'm right there. So I'm more excited than you are. Go ahead.
Before we do that, we just wanted to give a shout out to Sean. He put a rating on the podcast, which we do appreciate it. You know, and Sean sounds like a pretty smart guy. Okay? Probably. Well, he has ESQ after the name, right? So they got to be smart. But he starts with Cameron's got the hair. He is smart. True, right? Anthony's got the brains. True, right?
Debatable.
Between them both, they got a crack team. Jokes aside, these guys are terrific and outline difficult subject topics or financial topics clearly and articulately, even though I couldn't even read it articulately. But Sean, thank you for the comments. We really appreciate it.
Yeah. Thanks, Sean. He's very smart.
And observant.
Exactly. Absolutely. All right, let's get into this, right? We called this episode Not Your Mama's Whole Life for a reason. Anthony just touched on it. Is the biggest thing that we're going to talk about today is going to be the design on whole life insurance, right? And IBC is in its own little category. So the history, what we talk to when we say your mama's whole life, is that is the traditional way that people have designed whole life insurance. And like Anthony alluded to, if I'm totally honest with you, I'm not a fan of that design.
Correct.
I'm not a fan of 100% of premiums going into the base policy. And the reason for that is I think that's what you're going to touch on. So I won't ruin it right now. But what I want to do is I want to introduce you guys to really the design and a couple features of what we're going to be talking about. The whole life insurance, when you put premiums into a policy, you can choose where it's going to go. Your mama's design has 100% of that premium going into base, and base premium is really what goes to support that death benefit. Mm-hmm. The way that we communicate this to clients is that base portion is really the insurance portion of the policy, right? So you pay base premium, you get a big death benefit. What we're doing differently with IBC is we're actually adding on an additional rider. It's called a paid-up additional rider. And so what you do is you can minimize the amount of base premium that you pay, and then you add this rider that makes up for it in cash. the way that we typically communicate that to clients is anytime you hear PUA or read PUA is just think of cash. And so the design is completely different. Instead of having 100% base premium or base policy, you're going to have a minimal base policy with maximum PUA rider, and that's going to provide the most amount of cash value for you. So that's a good overview, right, for the basics. If you guys have questions, it's okay if you don't know the difference between base premium and PUA. Anthony didn't either. I had to explain it to him. Feel free to reach out to us. Hopefully get on my calendar. I'll explain it to you. Right. So, but now, Anthony, you ran a couple scenarios, right, between your mama's whole life and an IBC policy design. Introduce us to kind of what you did and then some of the results.
Perfect. And what we did is we just we ran two different illustrations. One, your mama's whole life, where each had a premium of $20,000 a year. So on your mama's whole life, that was all going to the base premium. On an infinite banking policy, we had split to put as much as we can to PUAs and less going to the base. So we're going to look at the death benefit, the cash value, the flexibility, and then even the agent's commission as well.
Let's do it.
Now, Cameron, but before we dive into this, you probably had some expectations of what the differences were going to be. Mm-hmm. Just to add a little more excitement, to drama to this. Were the results what you expected, or?
They were not what I expected. I was surprised by the results. And I think that the listeners will be too. So
I was not surprised.
No, liar.
No, I was in some ways I was, in some ways that I wasn't, because we had looked at some of this before, but very interesting at the end when we compare the two. But first thing we're going to talk about is what most people talk about when they're talking about life insurance is death benefit.
Okay.
And so what we did is at year one, or the beginning, with your mama's policy, death benefit, $1.3 million.
Okay.
Okay. IBC policy, $500,000.
Big difference.
Like almost a third.
Mm-hmm.
Right. And but what is interesting, let's go forward to year 10. Yo Mama is still 1.3 million. Infinite banking, 900,000. But so that gap was almost a third, or at least double. It's starting to narrow. And here, this to me was the most interesting. At age 70.
When did you start? Sorry, I don't know if you said that.
Oh, I'm sorry. I did a 40-year-old male at standard.
Okay.
Thanks for pointing that out. Mm-hmm. At age 70, your mama policy had 1.2 million. I'm sorry, 1.9 million. IBC had 1.9 million. To me, that was the interesting thing, that we both ended up with a very similar death benefit.
Yeah, that was a surprise.
Yeah. Now, if you listen to this podcast, probably not so worried about the death benefit, more focus more on the cash value. So at the cash value, your mama policy, first year, 0 in cash. Second year, 0 in cash.
Yeah.
Third year, 0 in cash. Okay. But IBC policy in year one, we had over 11,000 in cash value. Now, again, we compared year 10. In year 10, your mama had 180,000 in cash value. IBC had 221. So at that point, your mama policy, the cash value had not equaled the total amount of premiums put in. Mm-hmm. Okay, but IBC policy had. And again, what's interesting, we went back to year 70 or 40 or 70. Now your mama's policy had 1.1 million in cash value. IBC had 1.2.
Mm-hmm.
So it had more cash value, but really we're talking after 30 years to have, less than $100,000 difference. That was also a surprise.
Yeah, well, that was for me too. I was surprised by that.
Now, to me, one important distinction besides the numbers, right? Because we don't live on a spreadsheet. Things are going to happen. We wanted to talk about the flexibility between the two, right? And Cameron, you had talked about that base premium. I also refer to it as the have to premium, right? Because that premium has to be paid or the policy is going to lapse.
Mm-hmm.
The PUAs are optional, so we will call them the want to. If you want to pay them, you can, and if you don't, you don't. So what that means is if you have an all-base policy and you have some lean times, you still got to pay the full premium. But with an infinite banking policy, again, we can lower those PUAs or the want to and only pay the have to. So in this example, the have to premium on your mama's policy is $20,000. I mean, that the have to never changes. But on an IBC policy, that have to is going to be much less. The example we ran here, it was around $8,000. Now, another thing that I think is important, because we got to make sure this policy works during the good times, but more importantly, we need to make sure that it's going to work in the not so good times.
Mm-hmm.
And odds are there may be a period where you can't pay the premiums. So we need to have a plan for that. Now, one safe plan is we can use a cash value, take a loan to pay the premium. Now, you can't do that in your mama's whole life policy till you're 5. Okay, so that 5th premium, there's enough cash value to pay it. So those first couple years, you need to make sure that you're able to afford the premium. Now, with infinite banking policy, since that not only are we building more cash sooner, but our have to premium is lower. So we can actually have if we pay the first year policy in full, we can typically use a cash value to pay that premium in year 2.
Mm-hmm.
And so that adds some even more flexibility between the two.
Yeah.
Right.
Yep. And I was going to touch on a couple things there. The 2 points that you made there, I think, is probably some of the most common cons against infinite banking or whole life that you'll find that are out there, right, is a lack of flexibility and no to very little cash value. Mm-hmm. If you look at a policy pretty quickly and you understand the flexibility that you have with it, we've got a ton of flexibility and we've got a bunch of cash in there. And so once somebody kind of understands IBC and understands the policy design that we're trying to accomplish, those first 2 cons against what we're doing are really out the window. Mm-hmm. So anytime you hear somebody that's talking about, hey, this is terrible because of the lack of flexibility, very little cash value, typically you can dismiss that pretty quickly.
Now, great, Cameron. I would tell you, when I was first learning about infinite banking, mm-hmm. I went and did a lot of research, and I talked to some typical financial planners.
I remember you called me often.
Right.
For mentorship.
On your beeper.
Mentorship and guidance.
I went to these financial planners, tell me why this doesn't work.
Mm-hmm. And
one of the first things they told me was, oh, he's just doing that to get a high commission. But the interesting thing is the opposite is true. In the sample that we had looked at, for the commissions for the agent, for the most part, it's going to be based on that have to premium.
Yeah.
Right. There is some commission on the PUAs or the want to, pretty small. Mm-hmm. Right. But the bulk of it's going to be on that have to premium, and on your mama's policy, that have to premium is $20,000.
Yeah.
So the agent's getting his or her commission based off $20,000 premium. In the example we had looked at with infinite banking, our commission is based off of the $8,000. So that person is getting 2.5 times more of a commission designing it with no cash value for the first few years.
Mm-hmm.
So, and also, and I will tell you, to be honest, I think that's one reason why a lot of the financial advisors aren't promoting infinite banking or whole life, because what they see is, wait a minute, not only are my commissions going to be a third, but I have to do a lot more work. Right? With infinite banking, you're educating people, you're servicing them, and so we do a lot of work and make much less. But those advisors have a scarcity mindset.
Yeah.
Right? Because the way that we're presenting this is that this is an asset, and even though percentage might be less, our premiums are much higher. Right? Because people are viewing this as buying a asset. So I just wanted to add that little bit of 2 cents in there.
Great point, right? And I liked your little 2 cent comment because you're talking about commissions. That was good. But one thing, right, is I don't think this is discussed enough as far as commissions go in our industry. Is I think a lot of times people are pretty shy and closed off when discussing that. Is if you guys have questions, right, feel free to ask us, right? We're pretty transparent as far as kind of how this works, and we're up front with somebody that calls in and says, hey, what's this going to look like? I talked to a guy just the other day, and he was bemoaning the amount of commissions that were potentially going to be paid out, and I showed him. I said, hey, man, here's exactly what we're going to get paid, and he was like, you're kidding me, right? I said, no, right? Like, the way we design it is we're minimizing that portion of it. And so we'll be upfront, transparent with you guys if you guys have any questions. So hope that helps. But right. So
well, I'd say if you got questions, ask them. I mean, there's a link for a discovery call in the show notes, right? You get a call with Cameron or I, and we're also doing a monthly live stream on YouTube and Facebook. Yeah. So to make sure that you don't miss those, I'd suggest subscribing and liking our YouTube and Facebook page, and we're literally going to be here live. Ask us anything, and we will answer it. If you're unable to make it live, send an email your question to info@infinitewealthcourse.com or DM us on any of the social media platforms, and we will answer that question for you.
Yeah, Anthony, let's wrap this up. Let's we've kind of looked at a couple features here between your Momma's Whole Life and IBC. What would be a summary or takeaway that you've got here?
To me is at the end of the, this all-based policy, a lot of people are say bad things about it. What we just showed, at the end of the day, I mean, it's 30 years later, we're going to be around the same spot. So it's not terrible if you have an all-based policy. But just like I think you even alluded to it when we were prepping, is if we're going to end up at the same, I'd rather have more cash value early than not, right? Yeah. But what I want somebody, the goal, if you're listening to this, is to think when somebody's bad-mouthing whole life, they're talking about your Momma's Whole Life policy and not about infinite banking. And so learn more. If you got questions or think whole life or infinite banking is bad or no good, do some research and find out for yourself. Yeah. What would you add, Cam?
Well, my takeaway is I'm surprised that we got through this episode that's entitled This Ain't Your Mama's Whole Life.
Don't even say it.
Without any Yo Mama jokes.
Oh, okay.
Right? I mean, I think Yo Mama...
I love your mama jokes.
I know.
But Do you have one?
No, I mean, I think Yo Mama jokes are cheap.
I got a couple.
I think they're cheap, old, and overused, just like Yo Mama.
That was a well done. I'm not gonna. Yeah.
Thanks, man. Thanks.
Great.
Thanks.
Yeah.
Let's wrap this up.
Okay.
Hey guys, thanks. This video, right? This one was about kind of the hitting on the myth about old school whole life, your Momma's Whole Life versus IBC. Hopefully, we've highlighted some of the differences between the design. If we end up in the same spot, man, we're big fans of cash and having access to that. So, hope that helped you guys. Enjoy this episode.
Make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.